Hi everyone, and welcome to this session on unconventional monetary policy. As Jackie said, I'm the Deputy Head of the Domestic Markets Department at the RBA. And one of the things our department is responsible for is implementing the monetary policy decisions of the Reserve Bank Board. Now, as you can imagine, this has been an extraordinary couple of years for us as monetary policy has responded to support the economy through the pandemic. So just as we found ourselves taking extraordinary measures in our everyday lives that have never been required before, so too has been the case for public policy. The large and coordinated response from fiscal, monetary and prudential policy in Australia is unprecedented, as is the RBA's use of unconventional monetary policy tools. As the title of my talk suggests, I'm going to take you through this monetary policy response and the specific tools we've used to address this incredibly large shock to the economy. But before I do that, I want to set the scene with the economic environment as it was going into the pandemic, because this explains why our conventional monetary policy tool, the cash rate, wasn't enough on its own to address the economic impact from the pandemic. In 2019, monetary policy had been further eased or maintained at stimulatory levels in most economies, including Australia. This was because inflation had remained subdued and growth outcomes had disappointed around the world. What this meant was that most central banks already had very stimulatory monetary policy settings, with policy rates at very low levels when the economic shock associated with the pandemic hit. You can see from this graph that in Australia, the cash rate was already at a record low of 0.75% at the end of 2019. With little room to lower the policy rate further, the RBA, like central banks around the world, responded to the shock from the pandemic with a combination of conventional policy rate reductions and unconventional monetary policy measures. The nature of the monetary policy measures was also shaped by how the shock played out across the economy. In addition to the very sharp and large economic contraction, we also had a major financial market disruption as risk aversion and uncertainty among market participants rose sharply. This led to a widespread tightening in financial conditions when the economy could least afford it. Now, it was in this environment that there was a coordinated and unprecedented response from fiscal, monetary and prudential policy. In terms of fiscal policy, the government has provided significant support to Australians' jobs and incomes through a range of household and business support payments. On the prudential side, APRA has worked with banks to facilitate them supporting their customers, both households and businesses, by providing more flexible loan terms, including through repayment deferrals. And on the monetary policy front, the RBA has implemented comprehensive packages of policy measures aimed at keeping funding costs low and ensuring credit is available, especially to small and medium-sized businesses. Now, while the monetary policy packages have included unusual, unconventional policy measures because of the low starting point of the cash rate and the financial market strains, the aim of the measures has been very usual. So as always, monetary policy in this period has been directed towards achieving our overall objectives of full employment, achieving the inflation target, and ultimately the economic prosperity and welfare of all Australians. In the pandemic environment, that's translated to doing what we can to support jobs, incomes and businesses, and to make sure that Australia is well placed for recovery. The RBA's first package of policy measures, announced in March 2020, had 5 elements. I'll explain these in detail in the rest of the presentation, but to summarise at a high level, they were reducing the cash rate target and providing forward guidance for how it would evolve in future, introducing a yield target for 3-year government bonds, introducing a term funding facility to provide low-cost term funding to banks focused on supporting lending to businesses in particular, adjusting our market operations to support liquidity and market functioning, and finally, modifying how we implement the cash rate target given the changed environment. Together, these measures were aimed at keeping funding costs low and ensuring credit is available, especially to small and medium-sized businesses. Then in late 2020, as it was judged that more needed to be done to support the nascent recovery from the pandemic, the RBA announced another package of policy measures. And this involved further reducing the cash rate target, corresponding reductions in the yield target and the cost of borrowing under the Term Funding Facility, and the introduction of a bond purchase program. And the aim of this new package was to further lower the structure of interest rates in Australia and thereby support the economy by lowering borrowing costs, continuing to encourage the supply of credit to households and especially businesses, and delivering a lower exchange rate than otherwise. Now, in my talk, I'll explain each of the measures, starting with our conventional tool, the cash rate, and then working through how each of the unconventional tools work. So beginning with the cash rate. Now, the target cash rate had already been lowered by 25 basis points to 0.5% at the Reserve Bank Board's usual meeting at the beginning of March 2020. But following the extraordinary board meeting in mid-March, as the COVID-19 crisis escalated, the cash rate target was lowered by another 25 basis points. This took the target to a record low of 25 basis points, or 0.25%. In November 2020, the cash rate target was lowered even further to 10 basis points, where it remains today. Now, as you know, the cash rate is our conventional tool for monetary policy. And this diagram shows how it flows through to economic activity and inflation. A lower cash rate, which is the market interest rate for overnight loans between financial institutions, flows through to other interest rates, including deposit and lending rates for households and businesses, which then flow through via a number of channels as shown on the diagram. So first, we have the saving and investment channel. So lower interest rates encourage borrowing, investment and consumption and reduce incentives to save. Now, lower interest rates also reduce interest payments on outstanding debt, which helps households and businesses through what is known as the cash flow channel. And that's the second channel shown on the diagram. Third, we have the asset prices and wealth channel. Lower interest rates also support asset prices, making it easier for households and businesses to borrow and boosting their wealth, encouraging investment and spending. Now, another thing lower interest rates do is put downward pressure on our exchange rate, because investing in Australia becomes less attractive relative to investing in other countries. This makes Australian goods and services relatively less expensive than those of other countries, which boosts demand for our exports and reduces demand for imports. But it is worth noting that while borders were closed, we didn't expect to see much of an effect on trade in services. So this exchange rate channel has been muted compared with normal times. Now, as I've mentioned, we've reinforced the lower cash rate target with another less conventional tool of monetary policy, which is forward guidance. The board has made it clear that they won't increase the cash rate target until inflation is not just forecast to be, but actually is sustainably within the 2 to 3% target range. And this is to give financial institutions, households and businesses the confidence to borrow and lend and make spending and investment decisions on the basis of these low interest rates. Now, a question that you might ask is, given the nature and scale of the shock the economy was facing, why was the cash rate target only lowered by 40 basis points? As you can see on this graph, by comparison, when the global financial crisis hit in 2008, the Reserve Bank lowered the cash rate by more than 4 percentage points. But that was from a starting point above 7%. And the difference this time is that interest rates were already very low when the shock hit. So the cash rate target is now 0.1% or 10 basis points. The board didn't lower the cash rate target any further because they judged that pushing the cash rate even lower wouldn't be particularly helpful in the environment we were in at the time. While a lower cash rate would put some downward pressure on the exchange rate, we are unlikely to see much pass through to lending rates from any further cut to the cash rate. In other countries where the policy rate has been reduced to zero or negative rates, most banks have set a floor of zero on retail deposit rates. These banks have judged that it doesn't make sense, either commercially or politically, to charge households and small businesses negative interest rates on their deposits. That is, to charge them an interest fee for their deposits with the banks. So with a limit to how low banks can drive down the rate they pay for their deposit funding, this also limits how much they can lower the interest rates they charge to lend that money onto other households and businesses. And this in turn limits the stimulus that a further cash rate cut would provide. In addition, a lower cash rate might encourage people who rely on interest income to save rather than spend. So this brings me to the second unconventional element of the Reserve Bank's policy package, the introduction of a target for the yield on 3-year Australian government bonds. So in addition to our usual conventional practice of targeting the overnight cash rate, we extended this by also targeting a risk-free interest rate further out along the yield curve to make sure funding costs are low. So rather than just relying on the cash rate to anchor risk-free interest rates at this longer horizon, we targeted it directly as well. Now, this yield target was in place from March last year until the start of this month. I'll explain the decision to discontinue the target in a moment, but first I'll explain how it worked. So we chose the 3-year horizon for the yield target as it influences funding rates across much of the Australian economy, and it's an important reference rate in financial markets. Unlike in other countries, in Australia, household loans and funding instruments of banks and businesses are either at variable rates or fixed at a fairly short horizon of a few years. So longer horizons, such as 10 years, are more important for government funding markets. Now, the target for the 3-year yield was set at the same rate as the cash rate target. So it also reinforced the board's forward guidance that the cash rate will not be increased from that level until actual inflation is sustainably within the 2 to 3% target range, which the board expected to be some years away. The target initially applied to the April 2023 Australian government bond, and then to the April 2024 bond, when it became the bond closest to 3 years maturity later in 2020. Then in July this year, the board decided to maintain the target for the April 2024 bond, rather than continue to extend it to the next bond closest to 3 years maturity. So this kept the yield target consistent with the board's forward guidance at the time, which was that the condition for raising the cash rate wouldn't be met before 2024, based on the central forecast scenario. To achieve the yield target, the RBA was prepared to buy government bonds in whatever quantities were needed. Now, buying the target bond reduces its supply, raising its price, and therefore lowering its yield. And there are two important things to note about these purchases. The first is that we buy bonds in the secondary market, not the primary market. As an independent central bank, it's important that we retain the separation between fiscal and monetary policy. We don't finance the government. Instead, the government finances itself in the market. Nevertheless, our bond purchases do affect the market price that the government pays to raise debt, just as they affect the price that the private sector pays to raise debt. And this is, of course, the point, to lower funding costs right across the economy. The second point I want to make about these purchases is that the purchases in support of the yield target are different to the quantitative easing, or QE, that we're conducting with the bond purchase program. Now, there is a quantitative aspect to the yield target, so achieving the yield target did involve the Reserve Bank buying bonds and an expansion of our balance sheet. But it didn't involve set objectives for the quantity and timing of bonds that we'll buy, as the bond purchase program does. Rather, the aim of the yield target was more directly on the bond yield, which reflects the price of money and credit. The amount of bonds we needed to purchase and when, therefore, depended on market conditions and prices. As you can see from the graph, in early 2020, we bought a large amount of bonds to bring the 3-year bond yield down to the target in the environment of strained liquidity in government bond markets. And I'll talk a bit more about those strains later on. But as the 3-year yield settled around the target rate and liquidity returned to government bond markets, we were able to reduce the size and frequency of our auctions. We bought bonds only intermittently as required when the AGS yield persistently exceeded the target. As the economic recovery progressed, however, and faster than expected progress was made towards the bank's inflation goals, the Reserve Bank Board decided to discontinue the yield target earlier this month. And you can see the yield has now increased and is above 60 basis points. So let me explain this decision. When the yield target was introduced, the board assigned a very low probability to an increase in the cash rate over the 3-year horizon of the target. The central forecast scenario was that the cash rate would need to be held steady beyond that date, and the likelihood of an earlier increase in the cash rate was considered to be very low. But as the economic recovery has continued and the forecasts for inflation have been revised upwards, the distribution of possible cash rate outcomes has now changed. Given the bank's forward guidance that the cash rate won't be increased until actual inflation is sustainably within the 2 to 3% target range, it's still entirely possible that the first increase in the cash rate won't be before April 2024, which was the maturity date of the target bond. But it is now also possible that a lift in the cash rate could be appropriate in 2023. At the same time, as expectations of the future cash rate path had shifted upwards, there'd been a corresponding upwards shift in other term interest rates in Australia. This had also made the yield target less effective in assisting to hold down the general structure of interest rates in Australia. So given these factors, the board judged that it was no longer appropriate to maintain the target of 10 basis points for the April 2024 bond. Importantly, though, the rest of the monetary policy settings are continuing to keep interest rates in Australia low and supporting the economy. So moving now to the third element of our policy package, the RBA announced a term funding facility, which we call the TFF, for the banking system, with particular support for business credit, especially to small and medium-sized businesses. So banks could get 3-year loans at a very low fixed interest rate. The interest rate was set in line with the cash rate target, so initially 25 basis points, and then reducing to 10 basis points in November last year. Now, technically, it's not a loan, but a repurchase agreement with us, where banks have to give us high-quality collateral against the amounts borrowed. And under the TFF, banks could borrow as much as 5% of their total credit outstanding, helping them to continue extending credit to borrowers as the pandemic unfolded. They could also get additional amounts under the facility if they increased their lending to businesses in particular. So the amount increased 1-for-1 with additions to large business lending, but if they increased lending to small and medium-sized businesses, they could borrow 5 times the amount of the additional lending. So you can see it really was designed to encourage banks to support businesses, especially smaller ones, during the pandemic. More generally, the TFF is also reinforcing the benefits to the economy of a lower cash rate by providing low-cost funding to banks. By reducing the funding costs of banks, this in turn helps to reduce interest rates for borrowers. As you can see on this graph, the cost of 3-year funding from the TFF is well below the cost of funding raised from bank bonds for the same term. Taking into account that 5% of bank funding is now provided from the TFF, we estimate that the direct effect of the TFF has been to lower major bank funding costs by around 5 basis points. And just having the option of access to the low-cost TFF funding also put downward pressure on the costs from other funding sources. So, for example, when the policy package including the TFF was announced, bank bond spreads fell by around 50 basis points more than the bond spreads for similarly rated non-bank and non-financial corporates, that didn't have access to the TFF. So the TFF is clearly contributing to a lower cost of funding for the banking system. Now, the window to access TFF funding closed in June this year, and in total, 92 banks borrowed almost $190 billion from the TFF. The last of this funding matures in mid-2024, so the TFF will keep bank funding costs lower than otherwise for quite a number of years. So now moving on to the fourth element of our package, which was conducting bond purchases and expanding our daily market operations in the early stages of the pandemic to support market functioning and make sure there was plenty of liquidity in the financial system. As the magnitude of the challenge posed by COVID-19 became apparent in late February into March last year, financial markets struggled to reprice financial assets as risk aversion and uncertainty among market participants rose sharply. So risk premiums widened globally and volatility in financial market prices increased. For example, equity prices fell by around 30% at the time. This led investors to sell assets to raise cash in order to reduce their leverage and meet margin calls. So there was a widespread sell-off of even relatively safe assets such as government bonds, and this contributed to severe dysfunction in government bond markets, including in Australia. With far more sellers than buyers, government bond prices fell sharply, which means their yields increased sharply despite the worsening economic outlook. You can see that in this graph, which shows yields on 3-year and 10-year Australian government bonds spiking in the green shaded area. Now, normally with a deteriorating economic outlook and likely reductions in monetary policy rates, you'd expect government bond yields to fall, but the opposite had occurred. Given the role government bond markets play as a pricing benchmark, these strains flowed through to other markets. This led to a widespread tightening in financial conditions when the economy could least afford it. So to address the dislocations in government bond markets, the RBA held large and frequent auctions to purchase government bonds in March and April of 2020. This helped to restore liquidity and normal functioning in government bond markets so that the spike in yields unwound. This is important because government bond markets serve as the risk-free pricing benchmark for most financial assets. It's also important that bond markets function well so governments are able to finance their fiscal stimulus. Now, you can also see on this graph how the 3-year AGS yield stepped down as the yield target was also introduced with the policy package. And as I mentioned earlier, some bond purchases were also undertaken in support of that. Now, in these difficult conditions, the RBA also significantly increased the supply of liquidity in its daily market operations. This alleviated funding pressures in the banking system, met the increase in precautionary demand for liquidity, and ensured money market rates remained low. Our regular open market operations involve conducting repurchase agreements, or repos for short, where financial institutions essentially borrow cash for short terms from the RBA in exchange for high quality collateral. In March 2020, we increased both the amount and maturity or length of these repo operations. All of these repos had unwound by the end of 2020, and since then, there's been much less demand for funding at our regular market operations. In fact, so much so that we've recently reduced them to weekly instead of daily. Although, of course, we do stand ready to conduct them at any point if conditions require. The reduction in demand for funding occurred because financial conditions stabilised and because the liquidity already available for the banking system is now much greater because of our package of measures, including the bond purchases and the TFF. So the RBA pays for the bonds it buys by depositing cash balances in the exchange settlement accounts that financial institutions hold with the RBA. And funds lent to banks under the TFF are also provided as cash balances in these accounts. So both of these add to liquidity in the system. The large amount of cash or liquidity in the system means that money market rates have declined to low levels, as you can see from this graph, and this is contributing to low funding costs. This is the 3-month bank bill swap rate, which much of banks' funding costs are linked to, and the rate on RBA repos at our open market operations. So now moving to the 5th measure in the package. So this measure, which is related to the now very low level of the cash rate, is that we've modified how we implement our cash rate target. The RBA has for a long time operated a corridor system to implement the cash rate target, something that we introduced teachers to in earlier teacher immersion events, because it's not in all textbooks. And the concept is set out in this diagram, which shows the quantity of cash on the x-axis and its price, or the relevant interest rate, on the y-axis. Under the corridor system, the cash balances that banks hold overnight in the exchange settlement accounts they have with the RBA have historically earned an interest rate 25 basis points below the cash rate target. So this is the floor of the corridor, labelled the RBA deposit rate on the diagram. And on the ceiling of the corridor, in the event that a bank needed to borrow from the RBA overnight, it would be charged 25 basis points above the cash rate target. So that's the RBA lending rate on the diagram. In this corridor system, banks have no incentive to lend in the cash market at a rate lower than the floor of the corridor, because they could earn more holding exchange settlement balances with the RBA. Nor do they have an incentive to borrow in the overnight cash market at a rate above the ceiling of the corridor, because they could borrow more cheaply from the RBA. Now, historically, within this corridor system, the RBA has also carefully managed the amount of exchange settlement balances, or system liquidity, so that demand and supply are in balance. This has ensured that the cash rate remained close to the cash rate target. And this is the situation shown on the diagram. Coming back to the package now, things have changed from this arrangement, as shown on this next diagram. With the reduction in the cash rate to very low levels, the Reserve Bank Board decided to increase the floor of the corridor so that the corridor is no longer centred on the cash rate target. In other words, the bottom line on the diagram, the RBA deposit rate, has come up a bit. With the cash rate target at 10 basis points, banks now earn 0 on their exchange settlement balances instead of earning minus 15 basis points, in other words, being charged, as would have occurred under the old arrangements. This decision was made in light of the significant increase in the balances held in exchange settlement accounts due to the effect of the other elements of the package of policy measures, so the government bond purchases, the TFF, and the additional liquidity operations. Lowering the interest rate on these balances further would have increased the cost to the banking system. And this would be unhelpful in this context, where we were trying to lower funding costs, and banks have played an important role in supporting households and businesses through the pandemic. The large increase in exchange settlement balances has also changed the way the overnight cash market operates. So we no longer have the actual cash rate based on market transactions staying very close to the target. Instead, with the supply of exchange settlement balances exceeding demand, the cash rate has drifted below the target, but remained above the floor of the corridor for the reason I explained before. You can see this in the orange dotted line on this technical diagram, and here it is on the next graph in reality. The actual cash rate, the red line on this graph, is now around 3 basis points. So below the cash rate target of 10 basis points, shown by the blue line, and a bit above the corridor floor of 0. This has also happened in other economies where there have been large increases in balances held by financial institutions with the central banks, or in other words, large increases in system liquidity. This resulting lower cash rate is, of course, consistent with the aim of the policy package of ensuring that funding costs in the Australian economy are very low. So this brings us to the final measure in the package, the bond purchase program, which is commonly known as quantitative easing, or QE. because it is focused on purchasing a given quantity of government bonds. In November 2020, the RBA announced we'd purchase $100 billion of longer-term bonds issued by the Australian, state and territory governments over 6 months. A further $100 billion of bonds was purchased after that, and we've since announced we'd be buying $4 billion of bonds per week until at least February next year. By this point, the bank will have bought a total of $275 billion of government bonds under the program. And as this graph shows, we will hold around 35% of the Australian government bonds on issue. We'll also hold 18% of state and territory bonds on issue, and you may know of these as semi-government securities, or semis, which they're also called. As you can see, while our purchase program started later than that of most other central banks, our purchases have quickly approached similar shares of the stock of bonds outstanding. These bond purchases have been focused on maturities between 5 and 10 years. And the aim is to lower longer-term government bond yields, which act as the risk-free pricing benchmark for other interest rates. So this leads to a reduction in interest rates more generally. So if we think about how this fits into the broader policy package, the cash rate target is anchoring the very short end of the yield curve. The forward guidance on the cash rate and the yield target additionally tied down the yield curve a few years out. And then the bond purchase program is helping to further lower the longer end of the yield curve. So together, these measures have worked to lower the entire structure of interest rates in Australia and thereby support the economy through the usual channels I explained at the start of this talk, by lowering borrowing costs and delivering a lower exchange rate than otherwise. We think about the effect of the bond purchase program as occurring through two main channels: the portfolio rebalancing channel and the signalling channel. The portfolio rebalancing channel refers to the effect of the central bank's bond purchases adding to demand for government bonds, causing their prices to rise and the yields to fall. It also encourages investors into other assets, pushing up their prices and causing their yields to fall as well. The signalling channel works through the central bank's bond purchases, emphasising its commitment to keeping policy rates low for an extended period, because it's unlikely that policy rates would be raised while purchases are still being made. Now, an important thing to note about the bond purchase program is that it's the total expected stock of bond purchases that affects government bond yields, and we see this impact immediately. For example, we estimate the announcement of the bond purchase program last November led to Australian government bond yields immediately declining by about 30 basis points. This is because of the forward-looking nature of financial markets. So the total expected reduction in the supply of bonds and the associated increase in price or fall in yields is priced in by financial markets immediately. So the effect on yields happens straight away before the purchases actually occur. And this also means that the rate at which bonds are being bought in any particular week doesn't matter. It's the total expected stock of bond purchases that determines the amount of stimulus provided. So that wraps up the 6 elements of the RBA's policy package. And stepping back now to summarise their effect, our assessment is that the package has been working broadly as expected to support the economic recovery from the pandemic. The policy measures helped to stabilise financial conditions in the early stages of the pandemic and have worked to ease financial market conditions to very stimulatory levels, supporting the supply of credit to households and businesses at very low interest rates. Banks' funding costs are now at historic lows, and as you can see on this graph, household and business interest rates have all reached record lows as well. So that's what we've done in terms of monetary policy. But to finish, it's worth highlighting the important role fiscal policy has been playing through the pandemic too. In particular, the government's support measures have been helping to smooth out the very large shock to households and businesses' incomes, including from the recent lockdowns associated with the Delta outbreak. Fiscal policy is much better placed to provide that support because it can be targeted to the affected households and businesses, and its effect is immediate. By comparison, the broader support from monetary policy takes its effect over a longer period and is more generally supporting the economic recovery from the pandemic.